This conference will now be recorded.
Okay, so now we begin to get you introduced to the course. And in our theoretical framework, our goal is to provide useful information about the financial condition of a company. And everybody's got to be able to understand financial information. I don't care what your major is, I don't care what your discipline is. Everything revolves around the financial statements. And so we'll be learning in this course how to prepare an income statement, a statement of retained earnings, a balance sheet. You will learn how to do all of this by midterm, then a statement of cash flow after the midterm exam. So that's our goal in this course. This is the main takeaway, learning to prepare these statements. Who uses financial statements? Shareholders who, if you own stock in a company, you want to know how it's doing. Investors, if you want to invest in stock, bankers, customers, suppliers, and then current and prospective employees. If you're working for a company, or if you're planning on working for a company, you should look at their financial statements. You should look at their financial statements. We have some generally accepted accounting principles, and we'll come back to these. You can just scan these now. We'll come back to these at midterm and explain these. You won't have to understand these, but have it here for you to scan and look at. Here's a glossary of various terms. And here's an income statement. Sales, that's cost of goods sold, gross profit, less operating expenses, net income, taxes, net income after taxes. This is what you're going to be able to prepare in about 4 weeks, 4 or 5 weeks. You're also going to be able to do a statement of retained earnings, and you're going to be able to prepare a balance sheet. So the income statement shows how much income the business made for a period of time. The statement of retained earnings shows how much of the earnings are retained in the business, and the balance sheet shows the assets and liabilities in your equity. So you personally, probably a lot of you getting ready to file income tax returns, which will reflect the income that you made in 2021. All of you also have a balance sheet where you have your assets and your liabilities that you have in your liabilities. And if your assets exceed your liabilities, then you have a positive equity. So everybody in here generally has income. Everybody has a balance sheet. With companies, they just prepare the same thing based on what they have. Okay, so I think this is in course content, so you can look at that. Next, we want to look at the accounting cycle. So this is the main thing that we utilize as we get ready to prepare those statements that you looked at. So we're going to learn how to prepare those financial statements, but that's step 7. Step 1, we analyze business transactions. Step 2, we make journal entries. Step 3, we post to the ledger. Step 4, we prepare a trial balance. Then we make adjusting entries, adjust the trial balance, and then we prepare those financial statements that we looked at and do a couple other things. For the first 2 weeks of class, we're only looking at steps 1 and 2. That's all we working on. That's all you got to be concerned with. You got to learn how to do steps 1 and 2. Step 3 depends on, steps 1 and 2. And so it's critical that you learn how to analyze a transaction and make a journal entry. And as I said earlier, everybody in here will have to analyze a transaction and make a journal entry next week. So you got this week off, but your first 10 homework points are coming based on you analyzing a transaction and making a journal entry telling me what that journal entry is. So that's all we're concerned with. And when we get to making journal entries, you got 2 minutes to make a journal entry. You got 2 minutes. You don't have all day because you got these other steps to get to. So eventually you got 2 minutes to make a journal entry. Okay. So as we make journal entries, there are things to consider. Every financial transaction you got to record. So you told what the transaction, you got to record it. Every journal entry requires an equal debit and credit. And so we'll be reading the financial transaction, determining what journal entry is and making it. And we'll get back to this. We have debits and credits, and assets, typically gonna have a debit balance. Liabilities are gonna have a credit balance. Common stock a credit balance. Retained earnings if the company's doing well, credit balance. We'll get to that. Expenses credit, revenues credit, expenses debit. So you kind of want to look at this. And as you're going in and working with accounts, uh, you're looking at what their normal balance will be. So accounts can be debited and credited. We're kind of showing you how that works. Then at the end of the day, what they should like. Let me just see. There are a couple of other things we need to look at. Let's see if I can get through these. So this picture shows you where you're trying to go. Okay. So this is a picture of you once you get your degree. And then this is a picture of how you get there. This is what you're supposed to be doing now, studying. Uh, Another thing in getting to the accounting side, you got to think like you're running a business, like you're going to be an entrepreneur. You cannot be thinking like you're going somewhere to buy something. You're going somewhere to run the company. So you got to think in terms of I'm running a company. I'm running a business. Okay. So we might, if I put you in teams, have you select a corporate name, get you some articles of incorporation, create an organizational chart, do some things, and eventually issue some stock. And so we'll look at this in terms of getting your thought process different from what it is now, which is you just consuming, you buy things. And this is a simple looking at what a stock certificate looks like. So when you form a company, the first thing you do is you got to put cash in the bank and you get, this is your receipt, a stock certificate saying you got cash in the bank. And once you put the money in the corporation, it's the corporation's money. It's no longer your money. So just kind of keep that in mind. And then we record all the transactions so we can get those financial statements. This is the accounting equation. Assets equal liabilities plus stockholders' equity plus common stock plus retained earnings. So this is an equation you'll be memorizing. You'll see it all the time. This is the foundation of what accounting is about. Assets equal liabilities plus stockholders' equity plus common stock plus retained earnings. So assets, the liabilities, the stockholders' equity, which is the common stock, which you put in the company, and the earnings that you have. And the earnings that stay in the company is revenues minus expenses and dividends. So we'll continually be going through this, but you should be memorizing the accounting equation. When we expand that equation, cash plus other assets equal liabilities plus common stock plus retained earnings. If you form a company with $100,000 in cash, you got cash on one side equal to the common stock on the other side. The goal of a company is always to increase the cash and increase it through earnings. So if you put $100,000 to start a company, then you want the cash, other assets too, you want the cash to go up through earnings. So that's the bottom line of what a company is supposed to do. So if you look at a company and its cash is not going up, that's a problem. So if cash doesn't go up, just like you personally, if your cash is going down, it's an issue. So if you're running a company, your cash needs to be going up. Okay, let's look at our double entry system of accounting called debits and credits. And this is an Italian, Pacioli. He developed the system in the 1400s. In a business, in a financial transaction, in a business transaction, two things are happening. You receive something of value and you give up something of value. So in any transaction, any business transaction, what you receive is the debit, what you give up is the credit. So if you had a company and you bought some inventory paying cash, the inventory will be debited and the cash credited because you received the inventory. That's the debit. You gave up the cash. That's the credit. So there's always two sides to every transaction. So when you're looking at journal entries, you're looking at what the company got. That's the debit. What the company gave up. That's the credit. So we're always going to have two accounts. A debit is always on the left side. A credit is on the right side. So in our equation, assets are always going to be equal to the liabilities plus common stock plus the retained earnings plus the revenues minus the expenses and dividends. As we make in journal entries, this equation always has to hold. So every time you got a debit, you got to have a credit. And we'll just skip this for now. Let's look at a basic way double entry accounting works. Suppose you purchase an automobile paying cash of $10,000. You would debit auto $10,000 and you credit cash $10,000. Okay. So notice what happened. We got an auto. We debited that for $10,000. We gave up cash. We credited cash for $10,000. So notice the debit is always on top and the credit is on the bottom. Now, suppose we borrowed, we got the car using a note. We debit auto again, but we credit notes payable. Well, we got an auto. What do we give up? A note that we got to pay on. So two things happen, but we're doing it two ways. We get an auto. First case, we paid cash for it. Second case, we signed a note for it. Then in the third case, we paid $2,000 down and signed a note for the balance. So we debit the auto $10,000, credit cash $2,000, credit note payable $8,000. That's what a journal entry looks like. There's a debit for what you got. There's a credit for what you gave up. The debits and credit amounts must always equal. The debits and credits must always equal. So when you're making a journal entry, you will always have two accounts, a debit account and a credit account. So once again, we're just at steps 1 and 2 in this cycle, analyzing transactions and making journal entries, analyzing transactions and making journal entries. One of the things that I did, in terms of making it easy to make journal entries, I created the transaction types. And there are 20-some transactions, about 21 or 22. Okay. In our first 6 transactions, cash comes into business. So whenever cash comes into business, we debit cash and credit common stock. When we pay cash out, we're going to debit what was paid out and we credit cash. Then we have transactions other than cash. Purchase of an asset, utilizing debt, and sales on an account. Now, 2 things. You need a hard copy of transaction types. So when you come to class on Thursday, you have a hard copy of these transaction types. Secondly, I have bolded the transactions that we're working with. So we're only working with 1, 2, 3, 5, 7, 8, 9, 10, 12, and 15. So those are the only ones that we're working with now in terms of making journal entries. So what happens? It tells you what you're going to debit and what you're going to credit. So you read the transaction, then you determine the transaction type. Then that tells you what to debit and what to credit. The second thing that you're going to make a copy of the next time is a chart of accounts. Because when you make a journal entry, you got to get at least 2 accounts off of here. You need at least 2 accounts. And you got to have the account and the account number. So you don't just start writing accounts down. Your accounts that you write down has to be on this chart of accounts. It's got to be in here somewhere. So when you make a debit and a credit, you're using this chart of accounts. So here's the transaction types. And they tell you to debit something. Well, here, debit cash, credit common stock, credit account. It's telling you what to credit. But when you get ready to make that journal entry, you got to come in here and get the exact asset that's going to be debited and exact asset or liability, whatever that's going to be credited. That's what you got to do. So you want to have those two things copied. Because when you got quizzes and homework and things to do, you don't need to be flipping back and forth with whatever item you're using. So you need to have hard copies of these items. So I expect everybody to have a hard copy next time. So let's look at some examples and let's see what we're going to do. These are 10 transactions, financial transactions this business had. Does everyone see that, these 10 transactions? Does everyone see the 10 transactions? I gotta come in here and
Yes.
Yes.
Oh, I can see. I can see anything you shared this whole time. I can't see nothing.
the what?
I said I can't see anything that you're.
Can anybody else see? Can other people see?
I
Yeah,
can
I just
see.
Yes, I can see as well.
So Portia, most people can see, so you'll need to work on that. That happens. This is the first day of class. We'll repeat this next time. It's
I'm
being
sorry.
we'll review this again next time. That's number one.
Okay.
Number two, there's a YouTube video that's being made. And so you go to Joseph Boyd YouTube,
Okay.
you can get on YouTube, right? And you can see
Yes.
everything.
Yes, sir.
So you'll be able to see, and that's everybody. And we're going over it now. You go to YouTube and you review it. And it's going to
Okay.
show up like this. So it's in YouTube because it's a 4K recording. So I can't put it in Blackboard because Blackboard can't handle it. But on the other hand, you can get the YouTube on your TV. So you can get a big screen to see it. So that's the big advantage of it. Okay, so we invested 10,000 into the business. This is always the first transaction that we make. And I don't expect anybody to miss this transaction. This is the first transaction we make. I don't want anybody to miss this transaction because this is the first journal entry. You invested 10,000 to the business. This is always the first thing you got to do. You can't start a company until you get into financial things until you open a bank account. So what we're going to do is to go up here and look at transaction type. When we start the business, we're issuing common stock to start this business. So we have a type 1 transaction. Type 1 says we debit cash and we credit common stock, okay? So sometimes we will credit other things, but the key thing that we'll be doing is debiting cash and crediting common stock. Let me see if I can scratch these right now. So in this course, whenever you got a type 1, you're debiting cash and crediting common stock. So I know what my debits are and what my credits. Now I got to go in here and see what my account numbers are. Cash account number is what? 100. Common stock is 400. That is, if you got a bank account, you got a number for your bank account. So each one of these accounts has a number, and that's how things would be recorded in actual practice. So when we get ready to record a transaction, we're on number one. Okay, so this is item number one. Where did it go to? I don't know why I did all of that. Let me center, try one. I don't know, is that okay? Now the one is there. So this is just transaction one. First thing we do is we look into type. And we said this is a transaction type one. So our type is one. What do we debit in a one? we debit cash, and the cash account number is 100. So we're going to go in here. The account number is 100, and we're debiting cash. And our amount was what? 10,000. So we got to have an equal credit now, 10,000. So the business got cash. We gave up those common stock certificates. So
Is
we're
this
going.
a journal entry?
This is a journal entry. This is journal entry 1, and in a journal entry 1, it's telling you debit cash and credit common stock. So we go in here into the T account to see what the number is for common stock. It's 400. So we're going to put a 400 in here for common stock. That is journal entry. That's all the journal entry is. Now, can everybody make this journal entry? Can everybody in here make the journal entry when you start a business? Is there anybody who can't make that journal entry? So that's kind of always how we start. That's kind of always how we start. And so next week, you're going to be making journal entries. Everybody will have a journal entry to make. You read it, and then you're going to tell me the type, what you're going to debit, what you're going to credit, and the account numbers. That's how we learn accounting. And you can't make journal entries. You can't do anything else because everything comes off of this. So you got to learn how to make journal entries. Lanisha, can you make this journal entry?
Not yet.
Not yet. We invested 100,000 into the business. We go up here. First thing we do, after we read it, is it a 1, 2, 3, 4, 5? Is it 1? Because we issue common stock to start our business. So the transaction chart tells us we debit cash and we credit common stock. All we got to do then is go down here, get the cash account, that's 100, get the common stock account. So you can see you need these hard copy next time, 400. We debit, what the business got was cash. We debit cash. What the business gave up was those stock certificates. We credit common stock. That's a type 1. That is a journal entry. So we got a little car rental business that we have. We have a car rental business. The second thing this business did was it received cash for car rental revenue. It got some cash for car rental revenue. So we need a journal entry type. So for those students who raised their hand and said that they're going to make what's the journal entry type?
I believe 2.
That's right, it's journal entry 2. So what do we debit in a 2? What do we debit in a 2?
cash.
50,000.
Oh,
I
let me
just
see.
cash, right? And
We
what do
debit
we
the
credit?
cash. The sale.
We debit cash and we credit sales. We know that the account number for cash is what? 100, but what is it for sales?
It's
500. So our amount was 50,000. So we're gonna come in here. We're gonna say that was a type 2, and so we debit 100 cash for 50,000, and we credit what? 500 sales, 50,000. So we read the transaction, and all we're doing is making these journal entries right now. We aren't going any further because if you can't make the journal entries, then you can't go to the additional steps. So journal entries are always first. Number 3, we said we collected cash on account from corporate customers. So, students, which one is that? Collected cash on account from corporate customers. Since cash is coming in, it's got to be 1 through 6.
3.
3.
That's number 3. What do we debit in a 3?
Cash.
What do we credit?
The receivable. The account receivable.
Well, we got some smart people in this class. And cash is 100, receivable is 110. So we're going to go down here and make a journal entry. The type is 3. And we're going to debit cash again for 100. Cash 100. We got what? 20,000. And we're going to credit that 110 account receivable.
$110.
That's all a journal entry is. And what happens with students in accounting, and I'll be in accounting 2 after this class, and there are going to be people who can't make these journal entries. And of course, that assumes that. And so what I do is I just simply spend 2 weeks on making journal entries so that there is no excuse why you can't make journal entries. So I'm going to make them this week. Then you all are going to make them next week. Everybody will be assigned a journal entry. I'll get you your assigned journal entries on Thursday. Okay. Let's see if we can get a couple of more in. We will have to. We finish at what, 3:45? Okay. Receipt of a short-term working capital loan. That's still cash coming in, so it's got to be 1 through 6. So which one is that?
Number 5.
That's number 5, and I do have them kind of highlighted. So the ones we're working with. So the number 5, we debiting cash, or what are we crediting?
We are crediting notes payable.
Notes payable. So now we know cash is 100, but what is notes payable? We're going to use 306 short-term note payable, okay? You have long-term notes, but this is a short-term one because it's working capital. So we're going to use 306. So we're going to debit cash 100. We're going to credit that note payable 306. And we said this is a type what?
5.
This is a type 5, so make sure you have your copies, because I'm not going to be flipping on next class period. I would expect you to tell us it's type 5. And we borrowed how much? So we debiting cash
25,000.
5,000. We crediting what?
25,000.
To what? Short-term note
To
payable.
14, yes.
I'll just put short ST note payable. Well, let's pay something. What do we pay? Number 5, we purchase supplies paying 1,000 in cash. So now, because we're paying cash out, we know we got to be somewhere in there. So whenever cash is going out, you got to be somewhere from 7 to 11, 8. And right now, you just 7 through 10.
A 7.
That's a 7. We paid out cash. We purchased an asset. What asset did we purchase?
The
Supplies.
supplies.
Purchase some supplies. What's supplies number? 130. So 130. Now type was what? 7.
Mm.
And credit and cash. Debit supplies. Cash. What was that? $2,000? 1,000. Now I'm going to jump to number 9. Purchase supplies on account 8,000. So I'm jumping to transaction 9. What's going to be our type now? We purchased something, but we didn't pay cash.
Number 12.
It's going to be a 12. Purchase an asset utilizing debt. So it's supplies again. Well, we look in this chart of accounts, and that's going to be an account payable 301. So once again, we debiting supplies, but we're now crediting accounts payable. We said that was a number type 12. So no cash is involved in this one. We're still getting supplies, but we're now crediting accounts payable. And our amount was 8,000. Are there any questions? Are there any questions on journal entry and making journal entries.
One question. You said the debit and credits, they always match?
Say that again.
The debit and credit, they always match?
They always got to be equal. You might have more than one account on one of the sides, but at the end of the day, the debits have to equal the credits in each transaction. As we saw when we bought that auto, and we had the note for part of it. The debits must always equal the credits.
Thank you.
Are there any other questions?
The book that we're supposed to have, can you show us what it's supposed to look like if you have it?
Say that again.
The book that we're supposed to have, can you show us
Here it
what it
is.
looks like?
Okay, let me see. Stop sharing. Here it is.
Thanks.
So,
So did we not need the second book you suggested?
no, that's just a suggestion. You know, if you're an accounting major and you want more, that's fine. But you'll be able to make it with this book.
Okay, thank you.
Any other questions?